Good morning everyone, I hope that you are doing well. Welcome to this new lecture on my public YouTube channel. We are going to take a look at a live execution that took on the 30th of September 2024. Recently, I've been introducing the public to the time cycles theory that I utilize on a day-by-day basis to frame high probability trading setups. Today you will be looking at a recording that I did for my private mentorship, in which I basically explained to them live whilst the market was printing what I was anticipating and how I would engage based on that anticipation. During this lecture, what I will do is I will walk you through the recording. We will not be looking at the live voiceover that I did because that is exclusive for my mentorship, but I'm going to do a separate voiceover for you to share some insights with you when it comes to the application of time and price cycles. Before we begin with the breakdown, I just want to share with you that many students of both my private mentorship as my public students took exactly the same trade based on the logic that I've been teaching them. If that doesn't inspire you, I don't know what will. Let's begin. Here we are on the hourly chart of Nasdaq first of all. And with this Nasdaq chart, what I was looking for was the following. Initially, we opened up this week and we ran up higher on Sunday. Once we formed this high, we then displaced towards the downside and we saw this CB get created on the hourly chart. This CB formed inside of this BC. This was crucial market information for me. To me, as long as Nasdaq does not displace above this CB, I'm anticipating a high to form in this area to then displace towards the downside and reprice towards sell-side liquidity. Therefore, this was my point of interest for the morning session. What I want you to see is that during the London session, we formed this high inside of that CB already. Therefore, to me, this was anticipated manipulation, which was going on right now since the 9:30 open, where they repriced it higher aggressively into a key buy-side liquidity pool, into the London high, which is the previous session high. That should already ring a bell if you have been paying attention to my lectures lately. And therefore, what I'm anticipating is that a rejection of this high will take place to then draw towards the sell-side liquidity engineered during the manipulation higher. That was the overall thought process behind this trade. So when we then take a look at the following, I want you to see that the market is now trading above that London high and it's trading above the high of that hourly imbalance as outlined based on the hourly chart. At this point, it's patiently a waiting game and we need to sit and wait for IPDA to show its hand to us. What I want you to see is that from the 9:30 open price, what we can see is that the market repriced towards the upside aggressively. So who has been making money all throughout this repricing higher, throughout that leg higher? What I want you to understand is that during that leg higher, what we see is that a lot of buyers, yes, a lot of buyers in terms of retail buyers are stepping in. They think that the market is very bullish when they see this run higher taking place. They think to themselves, oh, we need to go market long because else we're going to miss out on this expansion towards the upside. Now, what is crucial to see, as you just saw me already annotate, was the fact that there was a cracking correlation relative to this high right here, where ES created a lower high, Nasdaq created a higher high. That's very important to understand. When the market trades above that key high, as I just outlined based on that higher time frame chart as well, you need to understand that buy-side liquidity gets taken out. Meaning people were short during the London session and they placed their stops above that high. When the market expanded in their favor, they did not take any profits. So what that means is that the market rolls back towards their stop loss. What we see is that by running those buy stops, we also trap people into believing higher prices are next. Think about how every single retail miner trader is thinking now, oh look, it's going to be a bullish day, I need to buy this. Especially when they see 9:30 open up like this. Therefore, a lot of sell-side liquidity is engineered below all of these lows. We can draw a clear trend line from this low all the way to the right here. Now, what I need you to understand is the following. When looking at this delivery through the lens of time cycles, what I want you to see is that between 7 to 8:30, we initially dropped lower and we formed these relative weak lows here. The market then began to expand towards the upside, but notice how much back and forth going there was. This right here to me is a lot of engineered sell-side liquidity. If we apply time to this equation, what you can do is you can split this 90-minute cycle from 8:30 to 10 into 3 30-minute cycles, and you can see where the key highs and lows are. In this case, a key low is, for example, here, and a key low is, for example, here, because this is the current 30-minute cycle low and the current regular trading hours low, and therefore those are key sell-side liquidity pools to monitor, just like this low is very important. What we see is that the market is trading above the London high, and at this point I'm simply waiting. I'm simply waiting for IPDA to show its hand to me, but I already know that a swing high is likely going to form because the time is nearly right for that to occur. Therefore, all I'm waiting for is for the displacement leg, and I will go short the moment the price retraces. Here you can see me drop into the 15-second time frame, and I'm waiting for an imbalance to form. I'm waiting for a CB to form below this low. I want to see the market retrace into that CB, and then I want to see the market provide me with that shorting opportunity. Here you can see me annotate the CB, and notice I'm not chasing price. I'm waiting for the market to come to me. I'm waiting for it to retrace into that CB because that's the price level I want to trade off. We then take out the sell-side liquidity resting below this low, and I shared in the real-time recording that at this moment in time, one thing has to occur, and that is retrace. If the market does not retrace, I need to enter at a way later stage in the market maker model. But ideally, I want to see it retrace after having taken out this sell-side liquidity pool. Why should the market retrace after having taken out this sell-side liquidity pool? First of all, the time at which this low formed. Secondly, we need to engineer new sell-side liquidity inside this fractal, meaning the market doesn't just drop lower when it just expands towards the downside right away. Surely, when there's a news release or something that occurs, but when it comes to this type of delivery, where it's just regular expansion, retracement, expansion, what you see is that we need to expand lower, retrace before we can expand lower. That retracement engineers new sell-side liquidity after having taken out sell-side liquidity. And therefore, what you can anticipate is that this run higher traps people into believing higher prices are next again. So what occurs? New buyers step in. I want to go short against those buyers. So here we can see the market retrace into the point of interest, and you can see me go short inside of that CB. At this moment in time, to me, I'm anticipating the market to create a new morning session low, and the current morning session low is that low which formed between 7 to 8:30. Notice how the wicks tapped into that CB and immediately rejected them. That right there is IOFET, is institutional order flow entry drill. When you see that taking place, it's a sign that we're likely going to see speed and velocity towards the downside now, especially when you pair that with time. Notice how the market retraces into this upclose candle and then rejects it right here. At this moment in time, all there's left to do is wait for the market to deliver, because all the signatures are already present for the high to have formed at 9:50 right here, which is a crucial time, and that high formation took place after we purged this buy-side liquidity. In the lecture on time cycles, I shared with you that you could be paying attention to 10-minute cycles as well. If you would pay attention to the time at which this high formed, I'm going to leave this to you to study. But if you pay attention to the time at which this high formed, and you then look at this open of that new 10-minute cycle from 9:50 to 10, what you will see is that we open up, reprice above this high, and then reject it. That's a key algorithmic signature. Relatively equal lows get created relative to this low. Notice that we have formed an imbalance right here shortly after the 9:30 open. With these imbalances right here, they signal that everyone is thinking now, okay, higher prices are next. What do? They buy, they buy, they buy, and we of course know that the opposing is true. As you can see at 10 o'clock, I decided to take 2 contracts off on the lower end of that REBC, which I had annotated based on that RE chart. And you can see the market begin to gravitate towards the lower end of that RECB. One thing I want you to see, by the way, and that's for a little gem in here for those of you that are still watching this lecture. I know this is not the type of lecture that you're used to probably, but this is exactly where you learn a lot. Do you see how we form that imbalance by displacing through that RECB's high again? Yep. That right there shows that there's an urgency for the market to reprice towards the downside, and it shows that the time is right for every single premium rate to begin to function as resistance on price. That is what I try to outline within my latest educational lectures here on YouTube. That when the time is right, yes, every single premium ray will function as resistance on price until the drawn liquidity has been met. Meaning, until the drawn liquidity has been met, every single retracement higher could have been a shorting opportunity inside of this leg. I'm not saying you should trade based off this. I'm not saying you should based off any of the knowledge that I provide, because everything I share is for educational and or entertainment purposes only. I'm not a financial advisor, but I am just sharing with you my findings, and I share with you what I see within these charts. You may do with that information what you may wish. And there's nothing that I am responsible for, because I'm just sharing my own findings, and you basically understand that this is all meant for those educational and entertainment purposes only. Quick risk disclaimer in here. Notice how we retraced after having opened up towards the downside initially. We retrace above the 10 o'clock open into this CB. Notice how this wick went above it, but notice how the bodies kept on closing inside of this CB. That right there shows that the underlying order flow is bearish. At this moment in time, I'm waiting for the market to begin to displace towards the downside with speed and velocity. I want to see ES catch up to Nasdaq, and I want to see them both move in tandem with one another. To me, the 9:30 open price was the level to monitor. That right there was the level I'm interested in seeing the market gravitate towards. Notice how we retrace into this CB and then begin to expand towards the downside. We trade below that hourly CB's price range, and to me, now the underlying order flow is really bearish. At this moment in time, I never want to see the market displace above this CB again. Now, here comes the thing, guys. For those of you that understand the market structure shift pattern, that know what it looks like, you might look at this high here and think to yourself, okay, the moment this high gets broken through, I'm going to go market long and I'm just going to buy it because I'm going to look for higher prices. Why? Well, we took out sell side liquidity and we trade above this high, which set up the run lower into that low. Therefore, this is a high to buy off. Yes, that's what pattern trades do. Let me tell you something. What I want you to see is that we take out that high in a bit, we trade above it here, and then we reject it. Everyone that would be trading based off the idea of, okay, every single high that set up a run lower into a key sell side liquidity pool, and the moment that high gets traded above, now I should go market long, would get stopped out here. Why is this not CSD? Why is there no change in delivery state? Why? Because the underlying order flow is bearish. The underlying narrative is we went higher to go lower. Therefore, we must anticipate the market to begin to draw towards the downside. If you would go into your own charts, you would see that this high here, yes, was the low of a 1 minute imbalance. Guys, we're on a 15-second chart here. You're seeing me execute based on a 15-second chart. That is what I want you to understand. Now the market is coming in close proximity to that 9:30 open price, and this is where I want to take another partial. Notice how we react off that 9:30 open price. At this moment in time, yes, to me, this high should not get violated. Why? Because this high right here took out the buy side liquidity resting above this high. It traded into that 1 minute imbalance by doing so, and it repriced into the 9:30 open price whilst ES was still not creating lower lows relative to the 10 o'clock low. Nasdaq was already rolling over whilst ES wasn't, and that right there was to me something I was not a fan of. Simply waiting and seeing for them to move in tandem with one another. Therefore, you can see me annotate the wick of that candle, and I did not want to see the market displace above that. That wick right there is a bearish rejection block. In the current range, price should not invalidate that high. At this moment in time, all there's left to do is wait. Wait and see whether or not the market is in fact going to expand below that 9:30 open price. If it does, then that's the sign that we're looking for in order to confirm the bearish order flow. This session was the session in advance of the falling, in advance of Fed Chair Powell speaking during the afternoon session. So therefore I was also a bit aggressive with my partials for your info. It was a Monday, it's the final trading day of the quarter, of the third quarter. And therefore to me, all I'm doing is simply trying to basically get out as quickly as possible whilst the market expands in my favor, because it's likely going to chop around. I took another partial below the low, which formed shortly after 9:30, because that's a key sell-side liquidity pool. Notice as well, that's the previous 30-minute cycle low. And look how the market reacts after having taken out that low. I must admit, the partials that I took in this trade were, in my opinion, perfect, because I partialed exactly on all the lows that set up retracements. First partial, second partial, third partial. And does it always occur? Well, it isn't always that perfect, but when you apply the theory of paying attention to time-based ranges and key opens, you can basically anticipate retracements to take place. So that is something for you to investigate. Now at this moment in time, what you can see me do is I'm annotating this BC right here. This BC formed shortly after 9:30. And what you can see is that this BC set up the repricing higher. This BC right here might be looked at as, oh, I should go long off that BC. Why? Well, it's a BC, right? It should function as support and price. Wrong. Not every imbalance is an imbalance to trade off. An imbalance is an algorithmic signature, but an imbalance can also be a signal of manipulation in this case. What you can see is that we reprice higher into that London high. Surely this imbalance gets utilized to reprice into that London high, this red line. But look, to me, I look at this imbalance as the following. I look at it as a sign of manipulation having taken place. Therefore, the moment that we trade outside of that imbalance, I want to see the market find resistance inside of it. I don't want to see the market displace above that imbalance. Notice how the bodies are closing here at that red line, at that bearish rejection block based on the 15-second chart. When I saw this, to me, I was anticipating the market to continuously begin to roll over. Here comes the thing. Because we had Fed Chair Powell speaking in the afternoon session, to me, I just had one contract left open, and it would either run towards my final target of a new morning session low, the low that formed between 7 to 8:30, or it would get hit when it comes to my trail to stop. And if that would occur, I wouldn't mind, because I already took profits at logical levels and the low resistance liquidity run was already done. Notice that the market is now trading around that 9:30 open price again. It's trading inside of this long wick. I'm actively paying attention to 50% of this wick to see whether or not we're displacing through that, to see whether or not the market is going to find support inside of that or just fall like a knife straight through it. We close below the 9:30 open price, so now I want to see the market begin to accelerate towards the downside. To me, my eye is drawn towards this low. Why? Because this is the previous 90-minute cycle low. The low that formed between 8:30 to 10 o'clock. That is the nearest drawn liquidity for IPDA at this stage. This is a key sell-side liquidity pool. What I want you to see is that below that sell-side liquidity pool, we also have this imbalance right here on the 1-minute chart that formed near that final drawn liquidity, as you can see. This will be crucial in a bit. Notice that we reprice into the low of this candle right here, and we reject that low. That right there is a key algorithmic signature, and that's something you need to begin paying attention to when you're looking at quick markets, when you're looking at fast-paced markets. My mentorship students are smiling right now because they know exactly what that algorithmic signature is, but it's called immediate rebounds. When you see immediate rebounds taking place, it's a sign that speed and velocity is on the way. This usually occurs when the market is in close proximity to a final draw on liquidity, to a key sell-side liquidity pool. There's absolutely no reason for the market to reprice deeply towards the retracement leg, because there's no urgency for the market to do so. It's in a rush to get somewhere. It's in a rush to get to a specific level. In this case, this sell-side liquidity pool. Therefore, that's the level IPDA is locked onto. I'm now monitoring the reaction to this level to see whether or not it will get reached in the first place. If we do in fact reach this level, the reaction to that level will be crucial for me moving forward. I do not want to see the market fail to utilize this down close candle as resistance on price the moment that we trade below it. Notice that we engineer sell-side liquidity in close proximity to it again. What is the function of this retracement leg? This function right here is to engineer sell-side liquidity, giving retail-minded traders the idea that a support level has been reached, so to say, and therefore they're going market long in this area, place a stop loss below this low, and that's of course the right sell-side liquidity which we can target. Market retraces above the high which set up immediate rebalance, and that right there was a signature I was not a fan of seeing. So the final line of defense for me, for the market to begin to displace towards the downside, was the following. This upclose candle had to function as resistance on price. You might be wondering, that upclose candle, why that upclose candle? Pay attention to the times again when you look at my breakdown or when you go into your own charts. If you're just watching this recording and you're not going into your own charts to investigate, you're really missing out on a crucial learning opportunity. So don't waste this opportunity to learn. If the market would displace above this upclose candle, I would cut the trade. I did not want to see the market displace above this upclose candle, and by doing so it would also displace above the 930 open price and this imbalance which formed right here. I wanted to see the market just roll over from this upclose candle. When you know what ranges to monitor to gauge the order flow, your trading can become very objective, and that's what I'm showcasing within this lecture, in which you can really just try and basically listen to my overall thought process whilst I'm going through this position. Okay, this is not the real live thought process. I'm keeping that exclusive for my mentorship students because I'm hinting at very specific algorithmic signatures, but I'm still giving you access to the type of information that they receive. And this is the beauty in the way that I teach and in the way that I trade. What you need to understand is that what I'm doing is objective, meaning I'm paying attention to very specific time-based ranges and very specific prices. Therefore, what I'm doing is I'm trading based on time and price cycles. And therefore, what you see is that all my executions, they look the same because I'm constantly doing the same things. And that is also why my lectures might sound boring or why it might sound repetitive. But guys, wouldn't you want to listen to someone who's always doing the same things? Or would you much rather listen to someone that comes up with new things every single every single month or so, or every single week? Look, this is my new trading model. Oh, look, this is my new trading model. Oh, look, we're backtesting this new trading model, this or that. Or would you much rather just find one strategy based on time and price that's objective, that isn't hard to follow once you understand it, and that you can just look to repeat over and over again? So now we have traded below the low of this downclose candle, and we have seen a CB get created here. To me, yes, I never want to see the market displace above this high again. I never want to see the market displace towards the upside like this. Why not? Because we have come in such close proximity to this low, and therefore, to me, the only way that could be stopping the market from reaching that low would be this imbalance. And notice the reaction of that imbalance right there. They just stopped right in advance of that key sell-side liquidity pool, engineering more relatively equal lows, and then they begin to reprice towards the upside. When we then closed above this level right here, above this downclose candle, previous cycle low, to me that was already a big warning sign that they are likely going to draw towards my trailed stop loss, draw towards the 930 open price again. If that would occur, then I would be okay with that, and it would be no issue for me because I already took partials where I wanted to take partials, and this was just my runner. If this high would remain intact, this was the final line of defense, so to say, for the market to not hit my trail stop. What we can see is that the market retraces, and eventually it draws towards the trailed stop shortly in advance of 1030. It is what it is. Am I upset about the way that I managed this trade? Am I upset about not having taken the full pull, the full close right here? No, I don't mind. Why not? Because I've taken partials at logical levels, and you cannot go broke when you take partials. Just going to pause the recording here. I hope that you found it insightful. I hope that you were able to gain a lot of insights from it. I know I've been mumbling for a pretty long time now, and this is all done raw for your info. This is all done at one go, this recording. So I hope that you're able to learn from it. Please let me know if you would like to see more content like this, in which I break down these trades like this. And I would like to hear your thoughts on this overall concept. Want to wish you all the best. Good luck with your studying, and if you did not watch my educational lectures yet, I would highly advise you to do so. Be safe.